Now let's take a look at the bigger picture. Matthew Johnson is with us, president owner, Johnson Wealth and Income and Management. Thank you so much for being here. So the weakness is evident. The volatility is real. What are you thinking here?
Well, Nicole, thanks for having me back. I think we're going to see more of the same, quite honestly, when we think about what's going on. We have to remember that when 2020 occurred, the car was on the side of the road, right? The economy was stalled out. And to get that car moving, we've got to do two things. We've got to print a lot of money to be able to open up liquidity into the market. We've got to be able to lower interest rates to be able to stimulate people to spend money, because if there's an abundance of cash and it's cheap to borrow, people will borrow it and consequently spend it. Well, think of this economy as like a 1976 Lincoln Continental. This is a big car, and it's got a lot of mass behind it, and it's going to take a long time to be able to slow this down. So it really doesn't surprise me too terribly much that we did see CPI rise, despite everything that the Feds have been doing. But they seem to be so dogmatic about getting this inflation down and doing it as quickly as possible. I think that they're going to continue to stay extremely motivated to increase interest rates. Now, they may not do 3 more. They may only do 2 before the end of the year, but I have a feeling that they're going to continue to raise interest rates even into 2023. So it's going to be more of the same. It's going to be volatility.
Yeah, and how come if we don't have a demand problem and the supply problem is more of the issue, why are people worrying so much? Because if you have demand, things should keep going. There must be some hurdles along the way too, right?
There most is, and one of the things that I think that is pretty obvious is right now with the inflation that we're seeing, the government is trying to take care of the inflation by taking demand and squashing it down. Well, if you really want to take care of the inflation issue, then you need to work on the infrastructure. You need to be able to address that issue. And here's the thing, when you raise interest rates, you're actually taking and creating greater amounts of inflation. If we want greater capacity, let's just think about oil, let's think about microchips, let's think about any of the things that are necessities of life today, and we want more capacity, then we're going to have to build. And in order to build it, you're probably going to have to borrow. But now you're having to borrow money at a much bigger interest rate. Today, 9 to 12 months later, the same piece of property has twice the size of a mortgage payment. I just talked to a client earlier this morning, and they've had twice their house has been sold and twice it's fallen through. Last year, they had a HELOC that was at 3%, and the banker convinced him not to renew it. And now he's kicking himself in the pants because he's got a HELOC that's probably going to renew it somewhere around 6%. This is really technically affecting people where it hurts, and that's the pocketbook. And unfortunately, I don't see that what they're doing right now is going to have an immediate impact. It's not going to have an immediate turnaround. We're going to continue to see more and more of the same.
And so at the same time, with the tighter money supply and just making it harder to borrow and things will be more expensive going forward, is there any reprieve? I mean, how should investors begin to behave? Because they're seeing their 401ks going down, their IRAs, their house is becoming less because now prices are coming down. They're getting whammies from all sides.
Really are. And I think in many respects, the Federal Reserve is playing into that because remember, there's a lot of psychology to spending, right? When your 401k is up in value, you kind of have the wealth effect. You feel okay about spending your money. However, when your 401k is down 25%, you're not so apt to be spending that money. Is there a reprieve? Well, there's a couple of things that I think are very important to understand. Number one, we need to understand that growth stocks don't do as well in a rising interest rate environment. So we need to be looking for dividend-paying value stocks. Number two, it is hard to ignore fixed income right now. When you think about how fixed income is contractual in nature, it's paying a steady stream of interest or dividends, and you understand that those fixed income instruments are on the opposite end of the interest rate teeter-totter. Well, they've been hammered pretty hard. And that means that now we can buy fixed income at a substantial discount. That means that we've got higher yields, we can buy more of them, and we can probably be averaging 5 to 7% in income. That's really real. And then I think the third thing is it's also hard to ignore all the really good deals that are out there, but don't get greedy. Dollar cost average into these things, as I've said before, because I do believe we're going to continue to see interest rates go up until at least the end of the first, maybe even the second quarter of 23. And if that's the case, then we want to be just kind of nibbling and chipping away in dollar cost averaging into the stocks that we've got our eyes set on.
So at this point now, you mentioned some of these global companies such as FedEx and Nike and Dow Chemical and how they are already giving us some warnings. And so are you anticipating a recession? How worried are you about a recession? How deep? How long?
Worried about a recession? Yes, I am. I do believe that the recession is going to come. Now, whether or not the Feds are able to mitigate the damage from the recession, I'm not really so certain. I think that they're in a process right now that is taking us very close to the recession, and I think we are going to hit that. It is going to be that proverbial big, heavy car, right? So even if they stopped and they halted interest rates from going up, that's going to be a good signal to the stock market, right? But it's still going to have very long lag time within the economy. So it's kind of like, you take a tree, you chop the tree in half, it's going to take some time for that tree to regrow. And that's exactly what's happening. They're trying to slow down this demand. Mentally, it's having an effect on people. They're going to stop spending their money or spending as much of it. They're going to be more cautious, more careful. And so it's not really surprising to see these CEOs coming out saying, listen, we're feeling the effects of inflation and higher costs. We're seeing the effects of lower sales. Goodness gracious, look at Amazon doing their Prime. Look at Target putting a 50% sale on 3 months before Christmas because they've got inventories that they thought they could get rid of, but now they're realizing people aren't spending the money. So it's going to have this exacerbated rolling effect, and we have to be prepared for that.
And you said to get in, but do it slowly with dollar cost averaging. So don't just sit on all the cash, right? You said if you have the cash, get into some of those companies, but do it slowly. Don't get greedy. Nice to see you. Matthew Johnson, president, owner, Johnson Wealth and Income Management. Thank you.